All right, good afternoon, everybody. Thank you for taking the time to invest in today's workshop. What we're going to discuss today is focusing on the financials, top 5 strategies that the corporate affiliate optometrist needs to know. My name is Adam Schmela. I am by day a certified financial planner whose practice is dedicated to focusing on serving corporate affiliate optometrists. And for the last 8 years, our clients have chosen to work with us because of our dedication and compassion and authentic commitment to serve them and serve their business model. And what that means to clients is that at the end of our process and going through our process, they have a greater sense of clarity, confidence, and peace of mind as it pertains to their personal and professional financial plan and what it means to their family as well as to their business. And so what we're going to discuss today in the context of my career in working with corporate affiliate optometrists is I tend to hear the same thing over and over again, a lot of the same questions. And so what I'd like to do today in the next 30 minutes is take some time discussing with you some of the top 5 things that I hear and how you can take some of that information and apply it to your situation right now. So again, my name is Adam Schmela. I have a practice located here in Indianapolis, just on the north side of Indianapolis, and my wife is also a practicing optometrist, which has made it, as I kind of say to people, it's made it for a fun sandbox for me to play in and know your business in a different and unique way than what some others have been able to do. So again, we're dedicated to focusing with an optometrist, and the purpose today, as I mentioned earlier, is just to leave you with some action items that you can take away and implement into your own life, and as well as a few call to actions, and I'll emphasize these periodically as we go throughout the call today, as well as some specific takeaways. So let's just dive right in here. One of the first things that we hear people ask is, how do I go about replacing my income in retirement? I'm a business owner. I don't have a pension. I don't have a 401k that Walmart or Costco or JCPenney or Sears or whatever provided to me. So what are the vehicles and how do I replace my income in retirement? And so my first answer to that is, well, the first thing that we have to do is define retirement, especially for the corporate affiliated OD. What I mean by that is that most people that are in your position as an optometrist are passionate about your career. You're passionate about patient care. You've likely spent a lifetime or many years in your practice building up this practice to where it is today. And so the idea, in my mind, in my experience, of optometrists getting to the point of just calling it calling it absolute quits and walking away cold usually doesn't play in. Usually it's some sort of sunset scenario. And so replacing that income of what your back was doing while working with income from your assets is an important consideration. One of the other things that kind of plays into that is your planned retirement versus your actual retirement. It's not always the same, and we'll get into that in a little bit more detail in the next slide. Determine what goes and what stays. What I mean by this is making sure that you take the time to sit down and evaluate what type of quality of life you want to have in retirement. So many times I'll have people come to me and say, well, Adam, I have $1 million portfolio. Is that going to be enough in retirement? And my response to that question is usually, well, that depends. It depends based off of what you want your retirement quality of life to look like. A $1 million portfolio is going to mean different things to people based off of how much they're going to spend on a monthly basis. So someone that wants to spend $5,000 a month in retirement, $1 million is going to mean very different, or is going to have a different impact on their plan than someone that wants to spend $15,000 a month in retirement. So it's not only just about the accumulation of assets that you have, it's about understanding the withdrawal strategy and liquidation strategy that you have in place and knowing what you're going to have to take off your assets, how you're going to take them off how you're going to take distributions, and from a tax sensitivity standpoint, what the impact of taxation is going to have on those distributions to help you understand how much you need to have in retirement. The first step is to understand how you define your retirement lifestyle. And this is where I say it's the importance of a budget and how do you calculate this. So let's back up to those 2 bullet points here. The importance of a budget starts to matter a little bit more in retirement simply because we're in a position of having a finite resource. Again, one of the common phrases that I hear from optometrists that we serve is they'll operate on the principle, and this is true across all business owners, whether it's optometry or others. The common phrase that I'll hear for people that don't have an operating budget or don't look at the monthly expenses in their household on a monthly basis is that, well, I'll just make more money. I'll go up and pick up an extra day, or I'll open the store an extra day, or maybe fill in somewhere else if I know I have a higher expense, or the next 6 months I've got some additional expenses. We always get this feeling that we can out earn our spending habits. But in retirement, when the plan that we construct dictates a finite resource on a monthly basis, the importance of a budget becomes more important. How to calculate that? The best rule of thumb that I can give is, if you're not sure what your retirement plan looks like right now, my suggestion is to just look at what your total cost of living is today, remove from that hopefully debt, because I want you to be in retirement as debt-free as possible, including the house, although I know that's not always possible for everybody. But remove any additional debt, remove any savings that you have in place today, and remove about 15% of what you currently pay in taxes, because when you get to the point of retirement, you're no longer going to be paying Social Security and Medicare taxes as both the employer and employee, commonly dubbed the self-employment tax. If you have retirement assets, you'll pay income taxes and state taxes potentially, but you won't have those Social Security and Medicare taxes. So eliminate your saving strategy, some of your tax liability, and hopefully a lot of your debts. Outside of that, you're probably going to be spending as much, potentially more, than what you're currently spending right now. And so there's different phases to retirement, but that should give you a good baseline as to how much you should calculate on spending in retirement. The two things that need to be taken into consideration when you're doing this plan are taxes and inflation. And for that, a qualified planner can help you understand the implications of those two variables. Now, coming back to what I had said earlier about when you want to retire versus when you have to retire, this is a little timely piece here, because when you want to retire, it may very well differ from when you do retire. So this is a recent study and survey that was sent out by the Employee Benefits Research Institute, and the Retirement Confidence Survey has consistently found that a large percentage of retirees actually leave the workforce earlier than planned. In fact, in 2015, it was 50% for the 2015 survey. Many who retired earlier than planned did so because of a hardship such as health problems or disability. That was actually over half. 60% of people that retired early did so because they had to. Though some state that they retired early, obviously because they could afford to do so, which is good. They did their planning. This tendency to retire earlier than planned may very well explain the considerable gap that exists between workers' expectations and retirees' experience. So it's kind of like retirement planning is two sides of the mountain. The accumulation phase, pre-retirement, is on the way up, and then the post-retirement, the distribution phase, is on the way down. When you're climbing up to the top of the mountain, most people think that they're going to retire later than what they actually do. And so just 8% of workers say that they plan to retire before the age of 60, compared with 36% of retirees on the other side of that mountain who report that they retired early. So again, what you plan on may not always be what actually happens. So it's important to have multiple different aspects of your plan in place. So kind of keeping on this theme here, some of the top 10 overlooked expenses in retirement as we go back to that budget. As you can see here, healthcare, income tax on retirement funds, the income tax on your Social Security benefits when you decide to claim those benefits, housing, an added vacation spot. The next three here is commonly dubbed sometimes being caught in the middle of the sandwich of having to care for elderly parents that maybe didn't do proper planning or require additional assistance, as well as helping out adult children and potentially grandchildren. So just make sure that you're managing those expectations and planning that it may come up in your retirement plan. And then insurance premiums, and last but certainly not least is inflation. So these are just some top 10 overlooked expenses that we see people not taking into consideration. Number 2, what retirement plan is suited for my practice? The most common types of plans that we see people bring into our office prior to working with us are SEPs and simple IRAs that they've set up. So what we tend to eventually introduce, depending on the practice and circumstances, is the 401k and introducing the Roth 401k as well. So the 401k has some advanced strategies that you can implement into that, as far as depending on the profitability numbers of your practice and where you're at right now and what your retirement plan, your personal plan, what your personal financial plan calls for, there may be some additional bells and whistles, as I like to say, that we can tack onto the 401k. But the 401k, specifically the solo K or Uni-K as it's sometimes called, can be a very good solution for the corporate affiliate optometrist, because if you're filing your taxes and as a corporation and you are the only employee in that business, it can be very lucrative for you to get some good tax deferred growth, help you on a tax standpoint today, help you for retirement planning down the road. And even if you do have team members, a 401k can be a very good vehicle to use as far as building in team loyalty and all those things. And again, that I don't want to dive too deep into that. We can always have a follow-up conversation if there are specific questions. And always don't forget about your personal IRAs. So many times we get focused on what can I do in my practice to save for retirement, but don't discount the fact that if you do not have a 401k in your practice, and all you have is a simple or a SEP IRA, which are quote unquote non-qualified plans by terms of the IRS, regardless of how much you make, if you're not covered by a 401k, you can deduct contributions to your personal IRAs regardless of your income limit. I'll throw in the disclaimer here, make sure you work with your CPA to evaluate all these situations and with your advisor as well. But don't forget about the personal side of planning either. Which leads in number 3, reducing my tax bill. So many times, because we're business owners, we kind of see get the peek behind the curtain and see everything that's involved in managing a business. The first step, I'll revert back to topic number 2. Implementing a retirement plan in your practice can be one of the most important, beneficial, and impactful decisions that you make. Again, both in helping you mitigate and defer taxes today, as well as saving for retirement and providing that financial independence that we're all working for down the road. Track additional miscellaneous expenses. As a business owner, I always kind of joke there's a lot of gray area between when we're wearing our working hat and when we're wearing our personal hat. And so what I mean by this is, if you're doing billing at home and you're utilizing your home internet for work, make sure that you're tracking how much you use that. You can deduct part of your home internet expense on your business returns. If you have a lab coat that you wear, make sure you deduct the cost of that as well as the dry cleaning for that. Make sure that you're tracking your cell phone if you're on call and at your practice and you utilize your personal cell phone. Make sure you document the cost of your cell phone bill proportionately. Mileage, though you can't deduct the mileage between your primary place of residence and your primary work location, if you bounce around from lease to lease or you're filling in different locations, that type of mileage can be deducted. And currently with the IRS and mileage requirements and mileage reimbursement and deductions, it can add up to some serious dollars there. So make sure you're tracking your mileage. Business tax status, self-employment tax can be a huge one, whether you file as a Schedule C, which is a self-employed sole proprietor, or you file as a Subchapter S corporation, which is typically what we see most. Most optometrists come to us either already established as an S corporation or they're in the process of changing to an S corporation. But it's again something that we insert ourselves into the conversation with you, with your CPA, and with your attorney to make sure that the corporate structure that you have in place for your practice is best suited for your plans and intentions. But more times than not, the 1120, filing as an S corporation can really help reduce your tax bill while still falling in compliance with IRS rules and regulations. So, and again, kind of continuing on that right here, we have sole proprietor, 100% of net business income is subject to FICA taxes. FICA is just a fancy word for saying unemployment taxes, and even those are subject to IRS limits. And there's no opportunity to take a business income as a distribution. What that means is that there's no opportunity to take the profits out of the business without paying self-employment tax, again, subject to the IRS limits. As an S corporation, you have the ability to pay yourself a W-2 wage, which is still going to be subject to FICA taxes, to self-employment taxes. But as long as that wage is within reasonable expectations of what a salaried optometrist is making in your area, anything that you have in the business that's above and beyond your cost of doing business that you can take as net profit in the practice can pass through on your personal return and not be subject to self-employment taxes. So there's an inherent tax savings there. Without going into details, again, I'm kind of giving you enough to be dangerous here, and I'd always advise you to consult your tax advisor as well as a certified financial planner like myself to understand all the implications of those types of decisions. But it can really add up to some serious dollars year after year. Number 4, is my investment plan suitable? And what I mean by that is, do you have your investments aligned with the amount of risk that you're willing to take? And so subjective risk questionnaires nearly always miss the mark. What I mean by this is we've all filled out the questionnaires on investment websites that say in very general terms how comfortable you are with risk. But the downside to those is that, number one, we're always dealing in averages. And more importantly, it's not taking the actual investments that you have in your portfolio into consideration. And so together as an advisor and as a planner and with you as a client, we utilize a technology and utilize a resource that really helps us find your risk number. And what that does is in 3 simple steps, we can pinpoint your risk number, which is basically kind of your sleep number for investing as it's been dubbed. How much risk are you comfortable taking in a range of how much are you willing to risk in order to have a potential gain? We then match the individual investments with your individualized risk number to make sure that we're comparing true apples to apples, and then utilizing that in the projected rates of return of those investments and the ranges, we can now utilize that information to create a much, much more targeted retirement map rather than work in generalities. So just as an example here, when we look at the cost of volatility, what I show here is that as retirement gets closer, it matters more what you don't lose than what you make. And so are you invested properly for your risk capacity? If any of you are golfers out there, you'll know the name Jack Nicklaus, and I'm an avid golfer. I love very few things are better than spending an afternoon on the course. But Jack Nicklaus had one of my favorite quotes ever, and he always said, "It doesn't matter the number of great shots that you take; it's the number of bad shots you avoid that is the mark of a great golfer." And I think there's a very distinct parallel to that as there is in investing. So what I show here is the loss of an investment and then what that investment would have to make in returns going forward in the next year just to get back to even. So again, we see a portfolio, for example, that declines 40%. We all remember 2008, or maybe we do, maybe we don't. Maybe we want to forget about it. Ostrich in the sand mentality. But if we saw an investment that lost 40%, that investment needs to make 67% rate of return just to get back to even. So as I mentioned here, as retirement gets closer, it matters more what you don't lose than what you make. So as we construct our portfolios and as you manage your investments, we need to make sure that we're managing the risk. And if we manage the risk, history has told us in the way that the portfolios are engineered, the return will follow. And so that's an important aspect that we want to take into consideration, is just how are you positioned and how is your portfolio positioned. You can always click on this link here to fill out a free questionnaire. I can absolutely email you the results after you're done with it. I've had people tell me it's kind of like going to Vegas. You get to choose if-then situations and either-or situations. So people have told me it's kind of fun. It's a very unique questionnaire. If you can't access the link for whatever reason, be sure to let me know. Email me and I'll be happy to send you the link where you can go ahead and take that survey. Number 5, how do I protect, preserve, and grow my assets? What are the types of risk protection, translation insurance that I need to have in place? So managing risk appropriately is a part of every financial plan. And really when we look at it, all of financial planning, investing, insurance, taxes, estate planning, everything is simply the transfer of risk. But if we narrow down and focus our conversation around risk management, around insurance, these are the key pieces of insurance that you absolutely must have, in my opinion. Life and really not in priority here. You need to have life insurance, and I look at life insurance as being something that is meant to provide for liability elimination as well as income replacement, depending on your situation and what your goals and intentions are and the other aspects of your plan. We can utilize life insurance in different ways, but usually using life insurance in a utilitarian way like that is going to serve you well. Disability insurance is a very important piece, but often overlooked aspect of insurance. One plug that I'll put there on disability is, as a corporate affiliate optometrist with Energeyes, or if you're an optometrist with Walmart, we have agreements in place with some of our carriers to offer anywhere from 20 to 40% discounts on your long-term care insurance, and on your disability insurance. And typically those policies are at least, if not more, cost competitive than the AOA benefit package, AOA disability insurance that's offered through, I believe it's New York Life or MetLife. I apologize, I'm missing which provider it is. But disability is an absolutely important piece of risk management to have in place, and I would encourage you to all revisit that action item here to look at the benefit that you have, make sure that it's enough given your income. If you've had a significant increase in income, just make sure that your protection is in alignment with what your revenue is producing now. Long-term care is something that is always a conversation point for pre-retirees and retirees. It's commonly dubbed as nursing home insurance, though it is getting more and more so that claims are actually not being used for nursing home, but for everything else. So it's an important conversation to have. I will say that it's probably not good and right for everyone. So I'm not going to say it's a one shoe or one size fits all mentality, but it is something to consider. And then obviously health insurance. We do have resources and other providers that can help with all of these areas. So if you do have questions on it, regardless of what state you're in, I'd really encourage you to reach out to me personally. And if it's not something that I can help with directly, I would be happy and privileged to connect you with someone that can help answer your question and provide you the information that you need to make a decision and go forward. And again, like I said, every situation is unique. And so when we look at how do we protect, preserve, and grow, and honestly, I'm not sure where that 140278 came from and what that is. A little bit of a typo there. I apologize. But tips for insurance and how you can reduce your insurance. Increase your deductible. The higher your deductible, the lower the policy premium that you have. Look at an insurance refi. This typically can apply on life insurance as well as auto and homeowners insurance. What I mean by that is you may be able to increase the benefit without increasing your premium. You may be able to decrease your premium by keeping benefits the same, or for term insurance that you may have in place, there may be an opportunity to quote unquote reset the clock and kind of reset that 20-year term or that 30-year term or 15-year term without facing an increase in premiums. Utilize your HSA plans for additional tax savings. This is kind of your another added IRA that you have. If the healthcare plan that you have is a high deductible plan that qualifies for an HSA, HSAs are great vehicles to use as it pertains to healthcare planning, especially for retirement. And obviously make sure that you have an umbrella liability policy, especially being self-employed and having assets in a business, as well as the financial success and implications that I know you all have as being successful optometrists. So an umbrella policy is typically a couple $100 a year in addition to any homeowners insurance and additional liability coverage that you have. And we would encourage you to work with your property and casualty agent and provider to add that benefit to your policy. And it goes without saying, but your malpractice and professional liability insurance is a given. So we're at 22 minutes here. And so what I'm going to do is, in the essence of time, I do have a couple of questions that I wanted to get to before, and I guess I'll pause here. If you do have a question, there's a chat feature that you can that you can type your question in. It'll come through on my end. Be happy to answer any questions. If you have a question that you'd like to contact me offline about, maybe it's a little bit more personal, whatever that case may be, here is my contact information. Please feel comfortable reaching out to me. My intention in having conversations with people, and especially with corporate affiliate ODs, is to just learn a little bit more about your situation, determine what it is that we may be able to do to help, and work with you through that process to make sure that you're clear, confident, and capable about making the next decision, whether that's with us or someone else. What's most important to us is that you get taken care of. So we did have one question that was actually emailed into us before the webinar even started. A person has a SEP IRA, and she asks, if I have a SEP IRA, do I have to make contributions for my employees? And it's a good question. The SEP IRA has a little bit of latitude and flexibility around contributions for employees. And so if you have a SEP IRA, there's two criteria that need to be met in order to determine whether you need to make a match. Number one, if they're expected to make more than $500 in a year, then they are considered to be part of the plan. And so most people will make $500 in a year. And the year is a calendar year. It's not hire date. So if they start January 1, if they were to start, let's say December 15th, that is considered 1 year of service. So it's a little bit unfriendly as it pertains to that. The other criteria, which if you have high turnover or you don't have a lot of seniority with your staff, may help you depending on the situation and your perspective on it as it pertains to making contributions. So someone is eligible to be, or for you, you would need to contribute to their SEP IRA if they have been employed with you for any 3 out of the last 5 consecutive years. So again, any of the last 3 out of 5 consecutive years, you would need to make a contribution. The contribution needs to be equal across the board. What I mean by that is you can't make a massive contribution to your SEP IRA and then give them $500. It needs to be either an across the board percentage or dollar amount for all employees, yourself included. So for example, you may make a 5% contribution across the board, and that includes yourself. So just take that into consideration. This is a plug for how 401ks can be very utilitarian and provide some additional benefits as it pertains to structuring the plan and structuring the vehicles correctly so that you can take care of your team, build in team loyalty, make the contributions to their plan to take care of them for retirement, but it allows you as the employer to really stockpile the plan in your benefit and for your favor. Even your spouse, if your spouse may even be able to participate if they're active in the business as well. So 401ks, if you haven't taken a look at those already, would really encourage you to either reach out to us directly, talk with your planner about it, or if you're a do-it-yourselfer, research that online. But let's see, any other questions here? Simple. Can I move my simple IRA from an old employer, or from my old business to my new business? That depends. Well, yes. The short answer is you can always move a simple to a simple. You cannot move a simple to a traditional IRA until those dollars have been in a simple IRA for at least 2 years. So there's a little bit of a time period on that before you can move it from a simple IRA to any other retirement plan. Obviously, keep it in a retirement plan, otherwise you will pay taxes and penalties on that. Let's see, any other questions here? Pull up the chat feature. Okay. Short and sweet today. We're just coming up on a half hour here, so I appreciate everybody investing your time today. Again, as an advisor dedicated to focusing on corporate affiliate optometrists, it's our privilege and pleasure to have been aligned with you. For those of you that are on the call that I was able to meet in Chicago, I had a great opportunity and really enjoyed the conversations that we have there. And for those of you that we already have conversations going one-on-one, I'm looking forward to taking those further as well. So again, my contact information is there. If you have additional questions, please feel comfortable giving us a call, reaching out. We'd be happy to share with you our process and how we may be able to serve you directly. So thank you again for investing the time today, and best wishes for continued success. Enjoy the rest of the day, everybody. Thank you.